Hey everyone, this is Ed Keim, CEO over at Quantcha, and in this video we're going to take a look at some of the news and updates that are going on with our company and our products. We launched about 6 months ago and the experience has been great. We've gotten a lot of positive feedback and we've been able to really improve the product and provide a better offering for investors of all levels of experience. I've wanted to do some videos to provide better transparency into how we're developing the product and the direction we're taking things. And this is the first one of that series that we're finally kicking off. And we'll be doing these every 1 or 2 weeks or possibly every month depending on how busy things are and how much we have to share. But we do want to provide more transparency. And for people who are asking some direct questions to our support line, we want to provide some better video support for people who are looking to become better investors or use the tool more effectively, and also to offer some things like tips and tricks and help people really just take advantage of what we have available. So moving forward, expect some more of these videos, and definitely, if you can, subscribe to our YouTube channel because this is where we'll be publishing everything for the future. So now let's get into some of the details for this particular update. First thing we want to talk about that we're excited about is the Benzinga FinTech Awards. Before I even get into that, I want to thank everyone who voted for us via Facebook and Twitter to help us get into past the first round, and ultimately we were selected as a finalist for the stock or options screeners, the best in class of those. And it's fantastic to be among a group of great products, at an event for a ton of great companies. Financial technology is just booming right now, and if you'd like to check it out and see what's going on, pretty much all the major players in this space and a lot of related finance space or spaces in finance are going to be at the Benzinga FinTech Awards Gala in New York on April 8th. And there's still tickets available. I highly recommend everybody go and check it out. And we're going to be exhibiting there as well, so we'll have a little setup. So if nothing else, just stop by and say hi if you use the products, or if you don't, if you're interested, whatever, just come by and say hi because I'll be there and be pretty excited to meet people and see what we can do to improve things. The second news item that we were going to cover here today is that we are now licensing some of our data through Quandl so that anyone can download our volatility information and use it in their own custom trading tools or on their sites or however you want to use it, really. I mean, as long as you're just not going to take our data and resell it in bulk form, you can do basically whatever you want with it. There's different licensing levels. And Quandl is great because they are a company that is focused on providing a publishing channel for companies like ours to go out there and push data through. I definitely recommend checking out a ton of the other data sources they have because we're also a customer and we use several data sets they have in order to provide some of the functionality we have on Quantcha, as well as some of the internal stuff we do for market analytics and kind of predictive analysis. Particularly for our set, we provide a little over 60 daily volatility indicators for what is currently about 2,500 U.S. equities. Going back to 2002, we have history, and it comes to nearly 5,000 U.S. equities. And that data is partly historical volatilities, which include the close-to-close methodologies as well as Parkinson, and implied volatility for calls, puts, means, and the skews of those volatilities. And we are looking to enhance the data a little bit more moving forward, but the pricing is very competitive, and you really can't beat what Quandl offers as a platform to develop against. And like I mentioned, we are a customer of theirs, and we use just a few of their data sets, and the experience has been just fantastic so far. And I'm going to switch over real quick to give you an idea of what we're looking at. This is an example of what the Apple data looks like. This is the history we have. It goes back to, in this case, it's March 14, 2002, and this is just looking at the historical volatility, the 10-day historical volatility, and you can see that more likely what you'd be interested in is maybe like the historical volatility of 60 days versus the Parkinson historical volatility over 60 days, and let's bring that over into the last year, and you can kind of see that the close-to-close volatility tends to spike much more, whereas Parkinson's, which uses a different methodology, it follows largely, but it doesn't quite hit these spikes as much. Another interesting thing is if you take those pieces of data, and let's say we get rid of the Parkinson for a second, and we pull in the IV mean 60, which is the 60-day mean implied volatility, you can now see over the past year how Apple's implied volatility has fared against its historical volatility. using the close-to-close methodology. And you can start kind of cutting and slicing in all kinds of other details, like maybe you want to check out and see how the 30-day mean is against the 90-day mean and the 60-day mean over the last, let's say, 3 months, and then drill into that. And I'm just using, this is just the web UI that Quandl provides. There's APIs to export using JSON, CSV, or XML. There's tons of libraries. There's all kinds of tools and support for just pulling in Quandl data. And the great thing about the way they've structured it is that if you do write code or use code and you get familiar with how this stuff works, you can then go pull in any of the other data sources they have and incorporate those into your applications. And the programming model is basically the same. I mean, the data is going to vary based on what the fields are, but how you get the data is so consistent, which is a nice thing. And here's an example of just the most recent data set. We've got historical volatility at the 10, 20, 30, 60, 90, 120, 150, and 180 day durations. And then for implied volatility, it's 10, 20, 30, 60, 90, 120, 150, 180, 270, 360, 720, and 1080. In addition, we provide something called a skew, which the methodology for is, let's step over to that real quick just to kind of explain how that stuff gets put together. The methodology here is, sorry, I lost that. We step out for a second to get to methodology. The interesting thing that we do is our historic volatility actually works against a consistent trading day. So it's important because a lot of times you'll see historic volatility calculated using calendar days and then implied volatility calculated using trading days, or rather historic volatility being in the trading days and implied being in calendar. And so it's not really, HV30 to IV30 is not really apples to apples, but we make it apples to apples. So you can compare any given historical volatility with another HV, or you can compare it with the IV of the same term and it means something. We also have the skew. Some of the work we do here is, if we come down to the bottom skew, is to see, on this theoretical skew curve based on this 30-day mean implied volatility, we take the implied volatility at the 90% of at the money, so basically 10% below the current stock price, and then we subtract the implied volatility at 10% above the stock price, and you're able to get a kind of a view of the difference there and to see what the skew is in a fairly easy way. And we are looking to improve some of the methodology here to provide some more skew information, but the important thing is you can start to see patterns, and if you're doing any kind of analytics, it's really helpful to get to the details of how this stuff comes together. We've also done a ton of work around Quantcha.com, and in future videos we won't spend as much time going into the details on these because we won't have as much of a backlog, but there are 4 kind of key things over the past few weeks that we've been working on that I wanted to cover briefly. One is the forecast user experience improvements, and there's some key things in there to cover because we're doing some stuff that's pretty cool, but it might be a little overwhelming the first time you see it, and I'll demo that in a moment. We also added a new strategy for the option search engine, which is the long risk reversal, and that's basically where you go short a put and then you go long a call. That's typically with some kind of spread in the middle. So you might go short a put at 50 and long a call at 70, which the put helps to finance the call, and then you get the upside, and you don't lose money unless it goes below the put. And it's a neat strategy. It's a very common strategy. It's something we should have had from the beginning, but we didn't. But we got great feedback and we applied it. We also have a Greeks panel that I want to talk about when we get to that. It's a very good piece of functionality to have insight to if you're going to be placing trades. And we also added in some covered call reset buttons. This is very, very simple stuff that, again, was good feedback we had that we should have shipped with and we didn't in the first place. So I'm going to step out real quick and get us over into Quantcha. And so I'm going to start off just in the default view. We're going to use Microsoft here. It doesn't really matter. One other minor thing we added is the duration for the given expiration. So if you're looking at a given point, you say, I want to look at a stock that's I want to look at the trades that are 8 weeks out from now versus just having the dates, which wasn't as useful before. I'm actually just going to go 3 weeks out to April 10th, and we'll search the options. And this is the new forecast view. I mean, usually it's hidden up here, but then when you select out, you get this nice chart. And this looks a little overwhelming at first, and I'll walk through it. The first thing is if you change your forecast here, we have this click here to reset to the default 68% range. This is a kind of a key feature because it snaps it back in. The 68% range has to do with the standard deviation of the implied distribution. This is some math you don't really need to understand the genesis of, other than to say it is industry standard stuff here that uses the implied volatility to determine where the market expects the stock to end on this date. So if you take a look at the April 10th time frame, this curve matches what the implied volatility indicates the market is paying, whether it's buying or selling, sort of like that point of equilibrium of where the stock should end up. Now, getting into some of the details here, I'm going to hide everything by unchecking these guys. This is not a particularly interesting graph. This just says, I'm moving this around to see where I expect the stock to end up. The implied distribution is, as I mentioned, the likelihood of the stock ending up there. So you can see most likely it'll end up at around where the money is right now. But of course it could go up, it could go down. And since there is kind of an efficient market at place here, it's just as likely to end up here as it is to end down there. In most cases, that's how it works. The other thing we have is the skews. Now, the skews we have here are red is the put and green is the call. That's the kind of the methodology or the convention that we're using throughout Quantcha. And you can see that the put is trading at a higher implied volatility, meaning that if you take a look at, for example, at 47. This is just a relative number here to give you an idea. The exact numbers aren't as important as just to note that this, the 47 put has a much higher implied volatility than the 44 or the 42, and then as you skew down as expected, the 39 is much higher. And the calls kind of see something similar, although the calls across the board here for the implied volatilities we can calculate are lower than the puts, which is usually an indication of some bearish sentiment because people are willing to pay more for puts than they are for calls. That being said, this is skew stuff that you can show or hide if you want, depending on how useful it is for you to look at. Another important indicator is the open interest at the various strike prices. Now, open interest is something that just really says people are willing to hold the stock. In this case, or rather hold the option, there are a lot of people holding this, for example, at 45 calls. And so that usually is an indicator that either there's a lot of people who have bought calls because they expect the stock to go above that and become profitable, or a lot of people have sold calls and because they expect the stock to not get that high and they're in a covered call scenario or something where they're going naked those calls. Comparably with the puts, you can see that 44 is the strike and it kind of peters off as you get lower. So again, you can kind of interpret these how you want, but the point is instead of going back and forth to an option chain, we're putting it right here over the implied distribution and with the skew just to give you some insight. And of course, it can get a little busy, which is why we have the ability to hide these things. And the last option we have at this point is the volume. And so the volume is just a different shade of green and red here for the calls and puts. And they're thinner bars that are closer to the strike. So you can see sort of the overlay here. In the case where the volume is higher than the relative volume, again, I should point this out, is that each one of these bars, the open interest versus the volumes, they're all measured relative to each other. So in the case where we're just showing this open interest, you can basically tell here that the call open interest at 45 is about 50% more than the put open interest at 44. When we bring in the volumes, if I hide the open interest in a second, it's the same scale for these guys relative to each other, but it's not relative to the open interest. However, we do resize them and we rescale them so that you can see them next to each other, so that you can tell in this case there was a lot of volume for those calls at 44 in the last trading day, but the open interest tends to be most significant at the 44 on the put side. So this is something you can definitely read into and interpret, and our job is to provide that data there to make it easy to consume, and I think we do a pretty good job here with that. So that being said, kind of getting into that, another part that we wanted to talk about was some of the functionality that we have with the long risk reversal trade. So I'm going to say let's move this up here and be bullish, and we'll say that we expect the stock to close 44 to 45 or so. And of course you could just enter the data here if you wanted to, but we'll keep it there and I'll apply that. And now I'm going to come down to the strategies. The first thing I'm going to do is I'm going to remove the filters for my returns, make those negative 100, and then I'm going to choose only to see the long risk reversal trades. And you can see here the best for my forecast that I'm looking at with the current data is this one where they're selling, or rather we're buying the 41 calls and we're financing it by selling the 38.5 puts. And it's not really that much of a it's really not that much of a credit in this particular case. Maybe one that's a little more interesting could be could be around the let's say the 14s, a little better. And in this case, kind of drilling into this trade here, we can see, you're buying the 41 and a halves, you're selling the 41 puts, and you're getting the details on all that. But coming down into the Greeks and how those work, the Greeks are a set of measurements, and usually there's 5 that are the most popular. And these are metrics that help you understand how different factors that go into pricing options would impact the option price if they were slightly different. So think of these as 5 measurements that happen at an exact point in time. So in the case of the delta ties to the price of the stock that's underlying the options we're talking about. And so generally what happens is these Greeks are all tied to a specific option. However, when you have a position such as this risk reversal where we have a 1-to-1 ratio of the puts to calls that we're dealing with, you can sum them up to get a value that leads out to the total value, whether it's the total delta or the total gamma, and so on. So in this case, the indicators at a high level here would be if you have a delta that is positive, in this case this 92 we have, that's an indicator that if the stock were trading $1 higher, it would improve the value of the trade at this exact point in time by this amount. And these numbers are going to change, but this is a position delta, meaning that the entire position that you're holding would move by this much. Now, it's also important to note that sometimes you're dealing with range-bound strategies like butterflies or condors, where you might be, the condor might be something that arches up ahead of where the price currently is. And if that happens, then you'll have a high delta here, but then you'll get to a certain point if the stock keeps going up where it'll start to curve downward again, at which point the delta will turn negative, because if the stock moves up, it actually lowers the value of your trade because you're getting outside your hedge endpoints. And so when that happens, that's just something to be aware of, that the delta is a good indicator for how much what the position is. And if you're working with, in some advanced traders, we work with things like delta neutral strategies, where you do care that, for example, you might be short a bunch of Microsoft, and this might be a good trade for you because when you're short Microsoft, you get a -1 for every share. And so this might be a good hedge to say, well, if it goes in the other direction, at least I'm sort of balancing out the risk that I have, or what have you. And then the other Greeks I won't get into in as much detail because we do list out the explanation for them. They are all important in their own ways, some of them more important than others. Delta is, of course, probably the big one. And for people that like to do credit trades, something like theta is important, because theta indicates that as time goes by, if we were a day closer to expiration, this is how much the value of the position would change by. And if you're in a credit trade, this should be a positive number, because it'll indicate how much more value you get because that time eroded away. And so that's just a quick look through the Greeks panel. And then to kind of step out to the covered call screener very briefly, we added 2 reset buttons, and we may change the colors on these, but by default we have a few parameters that are set up. For example, the minimum option bid, the minimum open interest, and the minimum equity ask, and volatility numbers. So if you get yourself into a position where you're looking, for example, we had someone who's asking about, there was the ETF van, and when they did a search, nothing came up. And the reason for that is because our default filters kind of cut them out. So we have one option, which is to clear all filters. And if you clear all the filters, what that'll do is it'll actually set everything to the NEs and the zeros or the full ranges, so stocks can show up. Now, if we go back and we reset everything to default, or actually, I'm sorry, this isn't van here. So it resets also it also resets out the filter. In this case, we had something come up that did not work, and It may not have been van. That actually could be a mistake. But the point is, if you do reset to default filters, that will bring it back to where we have the default, which are kind of some smart defaults. And then otherwise, it'll clear all the filters, means just get rid of everything, including like the the minimum open interest, the minimum option bid, and stuff like that. And so that's a quick tour of the features we were working with and some of the new stuff that we've been doing. I'm going to cut back over to our slides again. Finally, just want to chat very quickly about the future videos we're going to be working on. We're going to be, of course, bringing product updates and milestones out. We're also going to try to include some tips and tricks content. So, for example, if you have a view on a stock that's trading earnings or on a big event that's coming up, kind of a way that you can use Quantcha to get some insight as to the relative value of one trade versus another, or how you can drill into expressing a specific view through an options trade. And also, we'd like to cover some questions. If you have a question about how to use the product, or a general options question, we can work with you to kind of figure out if there's a good way for us to answer that, and if Quantcha can help you find the right solution for the position you're in. And finally, as I wrap up here for this particular update video, just wanted to say thank you to everyone out there who's given us such great support over the past 6 months. We've had just an incredible welcome into the space, and it's been great. And so, thanks again, and we hope to have many more of these videos moving forward. And happy hunting to all you investors out there.